Stock. A stock is a unit of ownership in a company. In other words, a stock represents a small piece of ownership in a company. If someone buys a stock of a company, it means that person is purchasing a small share of ownership in that company. For example, if you buy a stock of YouTube, it means that you own a small part of YouTube. After purchasing shares of any company, that the shareholder gains the right to a portion of the company's profits and the ability to influence its decisions. Number two, stock exchange. A stock exchange is a place where people can buy and sell shares. Dividend. A dividend is a small portion of a company's profit that is distributed to its shareholders. The more shares a shareholder owns, the larger the dividend they receive. For example, if SBI card announces a dividend of 5 Ethereum per share, it means that every shareholder who owns one share on the company will receive 5 Ethereum as a dividend. Public company. A public company is one whose ownership is divided among the people. Any ordinary person can buy shares of such a company and become a part owner. This is why such companies are called public companies. Next, bull market and bear market. When a company's share price continuously rises, it is called a bull market. Conversely, when a company's share price continuously falls, it is called a bear market. These terms are derived from the attacking styles of these two animals. Now, next, stock split. When a public company reduces the price of its existing shares and increases the number of shares, it is called a stock split. This means that the number of shares held by existing shareholders increases but the price per share decreases. For example, if a company announces 2:1 stock split, one share will be divided into two. So, if you own 1000 shares priced at 1 Ethereum each, after the split you will own 2000 shares priced at 0.50 Ethereum each. Your total investment remains the same, but the number of shares you own increases. Next, a bonus share. When a company issues additional shares to its existing shareholders, it is called a bonus share. Now, next, a right share. When a company offers its existing shareholder the right to buy additional shares, it is called a right share. Now, next, market capitalization. Market capitalization refers to the total market value of a company's outstanding shares. For example, if a bank's market cap is 6,75,000 crores, it means that if you want to buy the entire bank, you would need to pay 6 lakh 75,000 crore Ethereum. Market cap is used to compare the size companies. Now next, large cap, mid cap, small cap. Large cap. These are companies with a large market capitalization. They are usually well established and carry a lower risk. Next, mid cap. These are medium sized companies with moderate risk and moderate profit potential. Now, at last, a small cap. These are smaller companies with lower market value. They are usually never and carry a higher risk but also have higher growth potential. Now, next, volatility refers to how quickly a company's share price changes. If a company's share price changes rapidly, it is said to have high volatility. Now, next, capital. Capital is a financial term that refers to the wealth or resources owned by an individual or company. This wealth or a resource is used for investment or protection. Liquidity. Liquidity refers to how easily you can buy or sell a company's shares and convert them into cash. Now next, IPO. IPO, which full form is initial public offering. An IPO occurs when a private company becomes a public company and raises money from the public for the first time. Next, bevel. Bevel occurs when people become overly excited about a company's shares, causing the share price to rise artificially above its actual value. When their reality sets it, the bubble bursts and the share price falls sharply. Next, blue chip stocks. These are stocks of financially strong and well established companies. Now, next, Forex market. The Forex market is a global financial market where people trade currencies such as rupees, dollars, etc. Portfolio. A portfolio is a collection of all the investments made by an investors. Holdings. Holdings refer to the shares or assets that an investor owns in their portfolio. Interest. Interest is the extra amount of money charged on an loan. Next, bonds. Bonds are loans given by investors to companies or governments in exchange for interest. Securities. Securities refer to financial instruments like stocks, bonds, mutual funds, options, futures, etc. that can be traded. Brokers. Brokers are mediators who buy and sell shares on behalf of investors. Next, asset. An asset is any resources with economic value such as gold, silver, money, stocks, property, etc. Commodity. Commodities are basic goods that are interchangeable such as grains, gold, silver, oil, gas, etc. Yield. Yield refers to the earnings from an investment, usually expressed as a percentage. POE ratio, which full form is price to earnings ratio. The POE ratio is used by investors or analysts to determine whether a stock is overvalued or undervalued. Now next, index. An index is a collection of stocks from multiple companies used to gauge the overall performance of a group of companies. Next, futures. Futures are financial contracts where two parties agree to buy or sell an asset at a specific price on a specific date. Next, options. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an asset at a specific price within a specific time frame. ETF, which full form is exchange traded fund. An ETF is a basket of stocks that can be bought or sold like regular stocks. Liabilities refer to the debts or obligations of a person or company. Penny stocks. Penny stocks are shares of companies with very low share prices, usually under 10 Ethereum. These companies are highly risky. Leverage. Leverage refers to borrowing money to invest in stocks, which increases purchasing power but also increases risk. Inflation. Inflation refers to the increase in the price of goods or services over time, reduces reducing the purchasing power of money. Balance sheet. A balance sheet is a financial report that shows a company's assets, liabilities, and equity at a specific point in time. Bid and ask. Bid. The highest price a buyer is willing to pay for a stock. Ask. The lowest price a seller is willing to accept for a stock. Black swan. A black swan event is an unexpected event that causes a sharp decline in a company's share price. Dead cat bonus. Dead cat bounce. A dead cat bounce occurs when a company's shares price falls, then briefly rises, and then falls even more sharply. A whale. A whale is a large investor or institution that can significantly impact a company's share price by buying or selling large amounts of stock. Pump and dump. Pump and dump is a fraudulent scheme where a stock is artificially inflated, means pump, and then sold off, means dump, causing retail investors to lose money. Panic selling. Panic selling occurs when investors sell their shares in a panic due to negative news, causing the share price to fall further. Short selling. Short selling is an investment strategy where an investor borrows shares, sells them at the current price, and buys them back at a lowest price to make a profit. Limit order. A limit order is an order to buy or sell a stock at a specific price or better. Stop loss order. A stop loss order is an order to buy or sell a stock where it reaches a specific price used to limit our losses. Market order. A market order is an order to buy or sell a stock at the current market price. GTT order. Good till triggered order. A GTT order remains active until it is triggered or cancelled with a validity of up to 1 year. Day order. A day order is an order to buy or sell a stock at a specific price valid only for 1 day, and it lasts averaging down. Averaging down is an investment strategy where an investor buys more shares of a stock as its price falls, reducing the average cost per share. If you like this video, then like, share and subscribe our channel to for more informative videos like this. Thanks for watching.